Talk about it further, we're joined by a featured guest of the morning. He's Brooke Thackray, research analyst at Horizon's ETF Management Canada. Thanks, Brooke, for coming in. Let me tell viewers what we're expecting from StatsCan when it reports the labour force survey in about 24 minutes from now. We're expecting a change in employment during the month of May of 21,300 jobs. That's the number that seems so difficult for economists to forecast. We often get a number very much at odds with that number. But the consensus call is for just over 21,000 jobs to have been created during the month of May. The unemployment rate is expected to tick higher to 5.1% from 5.0% in April. Historically, both numbers are low rates of unemployment for the Canadian economy. And then perhaps most critically to the Bank of Canada, average wages paid to permanent employees expected to grow by 5.1% during the month of May. That would be a slight downshift from 5.2% in April. However, not a whole lot of difference in some of those key numbers in May from April, if those forecasts are correct. What, Brooke, might be the response of the Bank of Canada, do you think, if we get a number here that is stronger than expected, if we get wage growth higher than 5.1%, for instance?
Well, we've seen the Bank of Canada move from a pause and then go back to a hike, which is good because they're being data dependent. They're saying, well, this is what the data is showing us. We now need to adjust to that. We've seen other countries also move from a pause to a hike as well. So if we come in with stronger than expected numbers, we still have a problem with inflation in Canada. And I think the Bank of Canada might raise again down the road. I mean, it's they want to nip this in the bud. We're seeing inflation higher than they expect. It's part of the system. And you're right, they will be looking at the average hourly wages as well. And if that number's high, because that really embodies the inflation, if that wages keep going up, that's when we get sticky inflation. So they're concerned with that. So particularly if that number's high, they'll be more likely to raise in the future.
Randall Bartlett will join us in now 22 minutes' time to talk about the numbers as soon as they are released. Randall Bartlett is the senior economist at Desjardins, so he's standing by to talk to us about the Canadian labour force survey when it comes when it hits the screens in about 22 minutes from now. You've got lots of thoughts on the U.S. labour market, where we largely see the same thing, despite the efforts of the U.S. Fed to slow down the U.S. economy, to bring inflation down. In other words, we see persistently stronger than expected labour market growth in the United States.
Well, we've seen inflation go down from a year ago. Last year was the peak at 9.1% in the States. We've seen inflation fall all the way back down into the 5% range. And everybody's, well, that's good news, and we're making some real progress. But if we take a look at other factors, such as PCE, the personal consumption expenditure, that's remaining sticky around 5%, and the core inflation is remaining around 5% as well. So the Federal Reserve's had to basically say, well, you know, let's maintain a tighter policy than expected. But we're starting to see unemployment starting to go up. So in the States, we saw their unemployment rate go from 3.4% to 3.7%. And when that's happening, and we saw the JOLTS yesterday come out, the job openings, the initial jobless claims come out, and it was higher than expected. So we're starting to see some cracks in inflation, not inflation, but in the unemployment, where we're seeing it slowly starting to turn, where unemployment is starting to creep up higher. And that may give some ammunition to the Federal Reserve to actually start to move on to a pause cycle right now. That could happen.
And one thing we're seeing, I believe, is average weekly hours worked by employees start to decline, and that can be a leading indicator, perhaps pointing to layoffs.
Yeah, before companies lay off, what do? They start cutting back the hours where people work, and they say, well, it's hours before bodies. I picked that expression up.
And there we're seeing what we're talking about there. With the you can see since 2020, we've seen average hourly weekly hours of all employees come down. This data comes from the U.S. Fed itself.
Yeah, and that's exactly what's happening. We're seeing companies cut back the number of hours, and we can see that persistent decline back down into the low 34 region of hours per week. And that's what companies are doing. They're cutting back the hours before they lay off. At some point, if the economy slows down, we're seeing a lot of leading indicators saying the economy is starting to slow down here. At some point, they're going to have to start laying off people. Well, we've seen the technology industry lay off people because they overhired during the COVID pandemic. We really haven't seen it in the manufacturing sector so much. but I think we're going to start to see something like that coming up shortly. And the number of hours is just a leading indicator of that.
Nonetheless, we're almost out of time. We have seen the headline number, which is the non-farm payrolls growth number, absolutely crush expectations at least twice in a row. The April number came in at 250,000 jobs added to the U.S. economy versus only 185,000 expected. And the May number came in at 230,000 jobs created. That was 70,000 more than was served. So how do we reconcile those two things? Number of hours coming down, but number of jobs being created absolutely decimating expectations.
Yeah, there's no question. But on the other hand, if you look at the household surveys, there's a different measurement for jobs being created. It actually lost over 300,000 jobs in the month of May. So we had the non-farm payroll come in at 339,000, much higher than expected. And then we saw the household survey come in much lower. They just count jobs differently. And so the non-farm payroll number includes 3 jobs if one person's working 3 jobs. And we're seeing people starting to struggle a little bit at the lower end. And so they're taking on more jobs. So you have to really take that indicator with non-farm payroll number with a little bit of a salt here. A grain of salt. I think the unemployment rate going up from 3.4% to 3.7% is probably more indicative. I expect the next non-farm payroll number to actually be quite a bit lower than what we just saw right now.